If you own a home in Canada, or if your name is on someone else's title, there could be a penalty heading your way in 2026. And many Canadians don't even realize they're at risk. Today, we're breaking down exactly what these property rules mean for you, especially if you're retired, on a pension, or planning to pass your home on to your family. Welcome back to the channel. In this video, we're covering some important updates to Canadian property tax rules that took effect in 2026. We'll talk about a tax called the Underused Housing Tax, what it is, why it's ending, and why it still matters if you haven't filed for past years. We'll also cover a new reporting rule for something called a bare trust, which could affect thousands of Canadian families who put a child's name on their home title. And we'll go over some updates to capital gains, the home buyer's plan, and a few other things you need to know before you file your 2025 taxes. This video is for you, the Canadian homeowner, retiree, and pensioner who wants to stay on the right side of the Canada Revenue Agency. Let's get started. Let's start with the Underused Housing Tax, also known as the UHT. This tax was introduced back in 2022. It was a 1% annual tax on residential properties that were considered vacant or underused. The idea was to discourage foreign owners from leaving homes empty. But here's the problem. Many regular Canadian homeowners got caught up in this tax too. If you owned a property through a small family corporation, a partnership, or a trust, you may have been required to file a UHT return, even if your home wasn't actually vacant. And if you missed that filing, the minimum penalty is $1,000 for individuals and $2,000 for corporations, trustees, and partnerships. Now here's the good news. In 2026, the federal government officially ended the underused housing tax going forward. Thanks to a new law called Bill C-15, there is no UHT return required for the 2025 tax year and beyond. But, and this is very important, the CRA has made it clear that the past years still count. If you were required to file a UHT return for 2022, 2023, or 2024, and you didn't, you are still on the hook. That means you could still face that $1,000 or $2,000 minimum penalty today. And the penalties can actually get worse the longer you wait. Here's a real-life example to help this make sense. Pause. Let's say you own a secondary property, maybe a cottage or a rental, worth $2 million. It's held in a small family corporation. You missed filing your 2024 UHT return. If you waited until January 2026 to file, the penalty gets recalculated, and some of your exemptions may no longer apply. In that scenario, the penalty could be nearly $6,000. That's a big jump from the $2,000 minimum. So the message is simple. If you think you may have had a filing obligation for 2022, 2023, or 2024, please speak to a tax professional as soon as possible. Don't wait. Now let's talk about something that could affect even more Canadians. It's called the bare trust rule, and most people have never heard of it. A bare trust is a legal arrangement where one person holds their name on a property title, but someone else is the real owner. You might be wondering, when does this happen? It happens more often than you'd think. Here are 3 common examples. A parent adds their adult child's name to the title of their home, maybe to avoid probate costs when they pass away. Very common estate planning strategy. A parent co-signs a mortgage for their child's first home. The lender requires the parent's name on the title, but the child pays the mortgage and lives there. Or family members share ownership of a vacation property through a holding company or a nominee arrangement. In all 3 of these situations, a bare trust likely exists. Pause. Now here's why this matters in 2026. Starting with the 2026 tax year, bare trusts that don't qualify for certain exemptions will be required to file a special tax return, called a T3 Trust Income Tax and Information Return. This return asks for the names of all trustees, beneficiaries, and the person who set up the trust. The deadline for filing this return for 2026 is March 2027. If you miss it, the standard penalty is $25 per day, with a minimum of $100 and a maximum of $2,500. But here's the part you really need to pay attention to. If the CRA decides you were careless or ignored your obligations, the penalty gets much bigger. In a worst-case scenario, the fine could be 5% of the total value of all property held in the trust. For a family cottage worth $800,000, that could mean a $40,000 penalty. Now, there are some exemptions. If the total value of everything in the trust is under $50,000 all year, you may be exempt. If the value is under $250,000 and all parties are related family members, you may also be exempt. But verify this with a tax professional. Don't assume you're exempt without checking. The key action step here: review every property where your name appears on the title. If you are on someone else's property, or someone else is on yours, that arrangement could be a bare trust. Now let's talk about what happens when you sell a property in 2026. The rules around capital gains have changed, and this is especially important for anyone thinking about selling a secondary property, a rental, or a vacation home. Simply put, if you sell a property for more than you paid for it, that profit is called a capital gain, and a portion of that gain gets added to your taxable income. Here's the updated rule. For profits up to $250,000 in a year, 50% of the gain is added to your income. For profits above $250,000, about 2/3 of that extra amount gets added to your income. This applies to sales on or after June 25, 2024. For seniors who have owned a cottage or vacation home for decades, a sale in 2026 could easily produce gains well above $250,000, which means more of that profit will be taxed at the higher rate. And if your property is held inside a corporation, the 2/3 rate applies to all of the gain. There is no $250,000 lower rate threshold for corporations. There's also something called the flipping rule to be aware of. If you sell a residential property within 365 days of buying it, the government treats your entire profit as business income, not a capital gain. That means it's fully taxable, and you can't use the principal residence exemption to shelter it. But there are exceptions for life events, and this is where seniors get some protection. If you had to sell your property quickly due to the death of a family member, a serious illness, a divorce or separation, or if you needed to move into assisted living, you may qualify for an exception to the flipping rule. So if you're in one of those situations, make sure your tax preparer knows about it. Let's quickly cover a few more updates that may be relevant to you. As of January 2024, any payment to the CRA over $10,000 must be made electronically. You cannot write a check or go to the bank for amounts above this threshold. If you try to pay with a check for a large tax bill, you will be charged a $100 penalty. Set up your CRA My Account online or ask your bank about paying the CRA electronically. It's straightforward once you've done it once. If you withdrew money from your RRSP years ago under the home buyer's plan, the 15-year repayment clock is ticking. If you made a withdrawal between 2022 and 2025, repayments start 5 years after the withdrawal. For most people, that means 2027 or 2028. But if you turn 71 in 2026, the full remaining balance must be addressed by the end of that year. If you don't repay the required amount each year, that amount gets added to your income and taxed. For pensioners already in a higher tax bracket, this could be quite costly. Here's some good news. If you are renovating your home to create a secondary suite for an aging parent or a family member with a disability, you may be eligible for a tax credit worth up to $7,500. The renovation must create a self-contained living space with its own entrance, kitchen, and bathroom. Just be aware, if you add an aging parent's name to your home title as part of this arrangement, that could trigger the bare trust reporting requirement we talked about earlier, so document everything carefully. Even though the federal Underused Housing Tax is now gone for 2026, some cities and provinces still have their own vacancy taxes. In Toronto, there is a vacant home tax. You must file a declaration every year, usually by early February. If you forget, there's a $250 fine, and your property could be taxed at 1%. In Vancouver, the empty homes tax is currently 3% and could go up to 5%. Again, you must file a declaration or face a $250 fine. In British Columbia, there is also a speculation and vacancy tax with rates that vary depending on your status. If you own property in any of these areas, mark your calendar for those filing deadlines. Missing them is an easy and avoidable fine. The most important thing you can do right now is review your property titles and talk to a qualified tax professional. These rules are complex, and getting the right advice early can save you thousands of dollars. If you found this video helpful, please give it a like and subscribe so you never miss an update on Canadian benefits, pensions, and tax rules. Leave a comment below if you have questions. We read every single one. And share this video with a friend or family member who owns property in Canada. Pause. They'll thank you for it. See you in the next one.